We have the threat of inflation. We have stock markets with record levels as far as price to earnings ratios go. And we have a rising interest rate environment. So, where does all that bring us? Please join me with this episode of your monthly economic update. Hey everybody, I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. Lots to talk about this month. A lot of things going on out there. You're hearing rumors of inflation. You're hearing about stock prices being at all-time highs. Bonds maybe not being the safe place to be either. So we're going to break it all down here for you on this month's economic update. Let's start with the equity markets. So I'm going to start out with a chart here of a few different things. We've got the S&P 600, the small cap, that's our yellow here. This is year to date up about 15.38%, followed by the Russell 2000 up 13.11%, mid cap higher by 9.86% on a year to date basis. We drop down to the Russell 3000, that up by 4.64% year to date. And as we roll on down here, one of our darlings of last year was the NASDAQ, the QQQ. And a lot of the big tech has taken a hit here recently. But remember, the NASDAQ was up over 40% last year, and small caps really just started making their run towards the end of last year and have been on a tear so far this year. So we're seeing a rotation of where money is flowing, more into small caps, more into consumer cyclicals. The Dow's picking up some steam. The S&P 500 staying kind of steady. Overall, right now, all the markets look decent. The Fed seems to be very, very accommodative from their comments this last week. And so what I anticipate is that we're going to see some volatility here. The big fear of the markets right now is roaring inflation. And you see headlines like we saw last week here on CNBC of home prices up by 10.3%. You look at what's happening in all sectors of the economy right now. It's hard to get goods and shipped from one place to the next. There's shortages on a lot of different things in the supply chain. All of that really still just part of the COVID hangover, and the prices on homes is really due to a dramatic drop in interest rates. So with that as the backdrop, let's step in and look at what's happening with bonds right now. So I've got two charts up here on bonds, and the green line here is AGG, and that is simply the bond aggregate. And so on a year-to-date basis, the bond aggregate AGG is a negative 2.11% on the year. We've got another one here, DPFAX. This is a mutual fund that holds senior secured debt and mortgage-backed securities. And so that sector of the bond market is actually holding up very nicely and should hold up very nicely in a rising interest rate environment. That up 2.24% year to date. I bring this up because, when people start talking about inflation, they start talking about rising interest rates, people automatically go, bonds are going to lose money. Well, that's true with some bonds, but not all bonds. There are bonds that do make sense in a rising interest rate environment. And remember this, that bonds are always meant to be the stay rich asset. So even though you may see a negative return on AGG so far this year, doesn't necessarily mean that it's going to continue to deteriorate. In order for that to happen, we've got to have the treasury rates, the longer term treasury rates, the 10-year plus, continue to rise. So let's take a quick look at what's going on with interest rates right now. So what we're looking at here is the 10-year treasury constant maturity. That is the right axis over here and the blue line. And so this little jump up that you're seeing is what you've seen happen so far this year. So the 10-year treasury so far this year has increased by almost 40 basis points from 1% to almost 1.4%. Now, you say, gosh, we still got a 10-year treasury at 1.4%. How bad can this be? The bond market's looking ahead and saying, gosh, when this COVID deal does really get out of the way and things start happening, the money supply is so big, it's so big that you're going to see runaway inflation. And the bond market is really looking at that, and you start seeing that sharp increase in the 10-year treasury, and that's what the stock market is scared of right now. And that's why I think you're seeing a lot of rotation out of the high-tech stocks over into Dow-type stocks, over into small-cap type stocks and consumer cyclicals. Those will do better in an inflationary environment and when the economy starts to really fully reopen. The second line on this chart is something called money velocity. Money velocity is defined as how many times per year does a dollar change hands. So if we go back here into the early 1980s, you can see that a dollar was changing hands about 3.5 times every year. Money velocity has been declining and declining and declining. And look at this, money velocity fell off a cliff during the COVID crisis. Now it's just now starting to come back. This is going to lag by about a month. So we'll have some more data on this later. This is what we're really going to look at when it comes to inflation. Will that money velocity pick back up? And will people start spending more money as the economy reopens? And I think that's what the bonds are looking at right now. But we really do have to have money velocity in order to cause inflation, because there's a couple of things that come into play. Most people think that money supply, the amount of money in the economy, is what drives inflation, but it's really the velocity of money. And again, that is how many times per year is a dollar changing hands. So let's take a quick look at a chart that shows money velocity versus money supply. So this chart's going to take us back to the early 1980s. And again, the red line here, that's your money velocity. That's the decline of how fast a dollar changes hands. The green line here is the M2, the money supply. So if it were true that money supply caused inflation, we would be seeing runaway inflation right now. But the reality is the money velocity has to be there. So where's the risk right now? The risk is this: if money velocity were to pick back up, even to get back to where we were, say a year ago, and the money supply that's out there today, that would definitely be something that we would start to get concerned about inflation. One of the things, if you're paying much attention, is Jerome Powell, Federal Reserve Chairman, just this last week said that he doesn't see inflation being a threat in the near term. I take that to mean over the next 12 to 18 months. Looking out longer term than that, we do have to keep our eye on it, because I think that the way that the economy is setting up right now, we could really start to see some inflation, but I think that it's probably going to be pretty benign over the next 12 to 18 months. I would anticipate this year we might finish in GDP growing by maybe 2.5%, and that coming off of a horrible year because of COVID. So with all that as the backdrop, what I anticipate we're going to see is some increased volatility. I anticipate we're going to continue to see the rotation out of some of the big tech names into more small cap, into more consumer cyclical, Dow type stocks. And so we'll keep a close eye on all of that. And of course, our goal always is to make sure that we're keeping an eye on what you've got going on. But more importantly, it's to make sure that your portfolio is structured so that you have the highest probability of meeting your financial objectives, your short, your intermediate, and your long-term objectives. Keep the lines of communication open with your financial advisor here at Barber Financial Group. If you're not a client of Barber Financial Group, it's really easy to have a conversation with us. We can visit with you by phone. We can visit with you through a Zoom meeting or some sort of virtual meeting, or we can meet in person. Any way you want to do it, we're happy to talk to you about any concerns that you may have and some opportunities that are out there and how we can help you. Thanks for joining me for the monthly economic update. If you're joining us on social media, make sure to like and share. If you're joining us on YouTube, make sure to subscribe to our channel. And I invite any comments and feedback that you have on the content that we put out.